Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. Welcome to Summer 2026 Tax Planning with the Personal Tax Planning Template Program. In this video, we are going to start by refreshing ourselves on where we should currently be in our 2026 personal tax planning process, and then we are going to jump straight into step number 7 of the 2026 Roth conversion flowchart, where we will practice together identifying room in the brackets during our sweet spot years inside of the personal tax planning template. Today's video is going to be a real down in the details working session within the personal tax planning template. So grab yourself a cup of coffee in your Number Crunch Nerds branded coffee mug. And by the way, if you enjoy this video, please like and subscribe, and let me know in the comments how your 2026 tax planning season is getting started. Okay, so here we are inside of the personal tax planning template, and what I want you to assume for this video is that the couple preparing this template has already completed steps 1 through 6 of the 2026 Roth conversion flowchart. They have entered in all known source data. In other words, they have prepared their 2025 column to agree to their 2025 as filed tax return. They have prepared their 2026 column with all known information to date based on the facts and circumstances year to date for this family. And they have prepared 2027 and beyond based on all of their known facts and circumstances again. So with all of that in mind, this couple is ready for step 7 of the flowchart. Step 7 being the identification of room that they have in their tax brackets during the Roth IRA conversion sweet spot years. Now, as a very quick refresher, let's take a look at the 2026 flowchart and make sure that everybody knows which steps need to be completed to arrive at the point where we are today for purposes of the example that we're about to walk through in this video. So, step number 1, enter your actual 2025 year-end traditional IRA and other pre-tax account balances like 401ks. Ideally, you should have had that complete inside of your personal tax planning template as soon as those balances became available to you from your broker or your employer right at the beginning of 2026. So everybody should have this complete, and the couple in the example we are going to walk through has completed this step. Then moving to step number 2, we need to project our traditional IRA and other pre-tax balance growth in order to arrive at a projected balance for all pre-tax accounts at our RMD starting age. So again, this is an item that you should have completed already inside of your personal tax planning template, because the information you need to arrive at this step is going to be these beginning balances, as well as your projected investment rate of returns from your pre-tax accounts. Okay, now that we have the projected balance of all pre-tax accounts at the RMD start age, the next step is to project RMDs through life expectancy. Once you have the starting balance over here in step 2, it's just a matter of applying both the investment growth rates to the remaining balances, as well as the RMD factors that come from IRS publication 590B. All of that is built into the personal tax planning template. So as of today, getting started with summer planning, all existing members of the personal tax planning template program should have been able to complete this step as well. And the couple in the example that we are going to go through in this video has completed this step. All right, now step number 4. This is the step that many of you may not have been able to complete until relatively recently. And that is because we have to enter our actual 2025 taxable income, which for many folks was not available until we hit April 15th, 2026. 2026 and your 2025 tax return was actually filed. So for everybody in the program, as well as everybody new just joining the program now, what you want to do in order to get step 4 complete is to prepare your 2025 column such that it agrees to your actual 2025 as filed tax return. If you have estimates for 2025 in there from earlier in the year, it is time to update those with actuals from your return. Every single member of the Personal Tax Planning Template program, whether you're an existing member or you have just joined or are planning to join, everybody can get help directly from me on this step right here, getting that 2025 column of the Personal Tax Planning Template to agree to your as filed 2025 tax return down to the dollar. All right, now with 2025 actuals entered into the Personal Tax Planning Template, as has been completed by the couple in the example that we're about to go through, the next step is to project taxable income through the early retirement drop and all the way out through the RMD starting age. Then we have to layer on the RMDs that we calculated up here in step 3. We have to consider the effects of widow's penalty, and in conjunction with doing those two things, we have to project our taxable income through life expectancy. So the couple in the example that we are about to go through has completed step 5 and step 6, and this is where we're going to focus in this video. Step number 7, we are going to go and identify room in the brackets during the sweet spot years, and we are going to do that based on all of the information that the couple set up in this example inside of the Personal Tax Planning Template using steps 1 through 6 of the Roth conversion flowchart. Okay, we're back on the Personal Tax Planning Template. Let's get started by simply doing an overview of the information that has been presented to us. So focusing in on 2026 for the moment, it looks like spouse 1 has recently retired. You can see right here, spouse 1 had been working for the prior 2 years, but as I said, they have set up this template with all available information as of mid-2026, and therefore we can reasonably assume that spouse 1 has just retired since they did not enter any W-2 information for 2026. And of course, right after you retire, or when both spouses become retired, that is where we tend to see the early retirement drop, because the total amount of income that folks tend to have in that situation drops off quite dramatically. We had about $360,000 of total ordinary income right here, about $360 again, and now down to $105, which makes this often the ideal time right in here to look for those Roth conversion opportunities. Now continuing down the list, it looks like the couple has interest and dividend income, which is consistent at around $20,000 of interest, about $8,000 to $9,000 of non-qualified dividends, and then down here about $12,000, $13,000, $14,000 of qualified dividends. What we can glean from that is that the couple has not made any dramatic decisions regarding their interest in dividend paying securities. In other words, I don't see any big change from one to the other or any of the amounts going up and down dramatically, which means at least as of the preparation of this personal tax planning template in mid-2026, no major investment decisions appear to have been made with respect to these particular items. Now, continuing down the list, it looks like we have a projection right here of $50,000 of harvesting of short-term capital gain. This is a nice round number, and it is also the middle of 2026 right now, so probably this is a number that the couple's financial advisor or broker provided to them, saying, I think we're looking at about $50,000 in short-term capital gain based on various investment strategies that the broker may have. Similar situation down here with the long-term capital gain at around $80,000. The only other item in 2026 appears to be an inherited IRA that has been going on for several years now. What is one thing that we can pick up right away about this inherited IRA? IRA, and it's that it looks like the couple is only taking the minimum required distribution. They're not accelerating any of the money coming out of this inherited IRA, and the result of that is in the 10th year we get a balloon. In other words, as things are set up right now, the remaining approximately $300,000 inside of that inherited IRA is going to be distributed all at once in this year right here. That is certainly going to cause a big bump to income and taxes if we don't do something about that. Continuing down the list, it looks like spouse 1 has a pension that starts right here at the age of 75. It looks like spouse 1 is planning to defer Social Security until the age of 70, the last possible year when it can begin. Same thing with spouse 2 right here, deferring the start of Social Security until 70. And then finally, here is the start of RMDs right here at the age of 73. Now let's scroll further down into the personal tax planning template and go to the ordinary income tax calculation analysis. So looking down here, what is step 7 of the Roth IRA conversion flowchart all about? And it is identifying room in the tax brackets during the Roth conversion sweet spot. So with that in mind, here are the tax brackets right here for this family. This section right around here constitutes the Roth conversion sweet spot. This section out here and going beyond off to the right constitutes RMD territory. And so my first question to you is, do you see room in the brackets in the Roth conversion sweet spot? And hopefully your answer was yes. Starting right here in 2026, we can see that the 10% bracket is full. However, the 12% bracket is not full. The reason we know that is because if the bracket was full, there would be a number appearing in the next bracket. So we have room in the 12% bracket in 2026. 2027 looks even more promising. The 12% bracket is completely empty, and the 10% bracket still has room. In 2028, the 12% bracket has room. In 2029, the 12% bracket has room. And then in 2030, the 12% bracket has room. And in all of the years mentioned, the 22% bracket is wide open. So in summary, the answer is absolutely we have room in the brackets in the sweet spot in this situation. We have 1, 2, 3, 4, 5 years of time that would make perfect Roth IRA conversion candidate years. Okay, let's go back to the flowchart for a moment and look at step 8. In step 8, we have to identify high bracket taxation in RMD territory, and as a side note, also considering beneficiary brackets. So let's go back to the example we're working on and do this step right here, because in order to find the ideal amount of Roth IRA conversion, 2 things have to be true. The first thing is that we need to have room to put the Roth conversions in other words, room in the brackets during the sweet spot years. We already established that we have that, but the second thing that has to be true is high bracket taxation in RMD territory, or really at any time after the Roth IRA conversion sweet spot, whether we've arrived at RMD territory or not, because we have to have something that is being taxed at higher rates in order to move it into the room in the bracket over here in the lower rates. If we don't have any income being taxed in the higher rates, well, in that case, then there's nothing to actually move out of those higher rates into the lower rates. So having one or the other of these isn't enough. We need to have both. We need to have both room to put the money in, and then we need high bracket taxation so we have somewhere to take the income out of so we can ultimately complete step 9, which is the performance of strategic annual Roth IRA conversions to fill up those lower brackets in the sweet spot years and smooth out that income and taxation. Okay, coming back over here to our example, let's see if we can find some high bracket taxation in RMD territory. So first off, I can see some already before we even start scrolling out to the right. Right here is a particularly glaring example. In this year, 2033, we have the 24% bracket completely full. We have the 32% bracket completely full. and we have the 35% bracket with some income going in there. So that is definitely high bracket taxation relative to what we saw over here in the sweet spot years. In addition to that, with this 22% bracket wide open here for these 5 years, any future year that has income being taxed at the 24% bracket would constitute high bracket taxation. Just to make sure everybody is following that statement, high bracket taxation does not mean any particular bracket specifically. High bracket taxation is a relative term. In other words, relative to the room that you have in the lower brackets, are you being taxed in the higher brackets in future years? So if you have room in the 10% and the 12% and the 22% brackets, then relative to that, being taxed in the 24% bracket or higher is going to constitute high bracket taxation. Now let's keep scrolling out to the right to see what else happens as we go further into RMD territory. So the first thing that should pop out to you right away is this row right here, the 32% bracket, is starting to fill up again. All of these years have money going into the 32% bracket. And what is the cause of this right here? Who can tell me? Well, the answer is right up here. This is the testing and planning for the inevitability of widow's penalty. In all of these years, up until this point, the couple was planning to file a married filing joint tax return. But based on the entries right here, we can see that the couple has set up their planning such that they can see the results of what would happen should spouse 1 pass as of the age of 84, and therefore spouse 2 would start filing a single tax return here in 2043. And the couple has set up their planning to evaluate what would happen if spouse 2 lives until 90 years old. And so the results of widow's penalty on income tax in this setup is going to be 6 years right here, where income is getting bumped up into the 32% bracket. So now coming back over here, let's put the pieces together. Step 7 is that we have room in the brackets in the sweet spot years. We have about 5 years of the 22% bracket being wide open. We also have 5 years with room in the 12% bracket, and we have 1 year with room in the 10% bracket. Conversely, step 8 is telling us that out here we have an opportunity to get this money out of the 32 and 35% bracket. Going further out, we have the opportunity to get this money out of the 32% bracket. And then in addition to that, we have ample opportunity to get some money out of the 24% bracket and into the 22% or lower brackets. So with that in mind, let's move to step 9 of the flowchart, which is to perform strategic Roth IRA conversions. All right, let me expand the window here so we have enough room, and the first thing I'm going to do is just scroll down to the bottom here so we can see this section. This is where we're going to look at our total tax calculation and effective tax rate for the entire life of the planning strategy. For example, in this case, the couple is planning from around age 65, 66, and then out until spouse 2 reaches the age of 90. Now right here we have 3 sections. The first one is going to be our base case. The second one is going to be our planning case. And the third one is going to be the difference between the two. Same concept right here. This is the effective tax rate for the base case, effective tax rate for the planning case, and the difference in effective tax rate for the two. This section here is the total tax paid for the base case versus the total tax paid for the planning case. The only difference between this right here and this larger comparison up here is that this larger comparison is by year, and this comparison right here is for the entire life of the calculation, in this case again between the age of 65 and about 90. We will also have the comparison break out the amount of income tax and the effective income tax rate from the amount of IRMAA paid and the effective IRMAA rate, and then this one right here is simply a combination of the two. Here's the critical item to focus on for the moment. It is not the amounts that are shown here. Instead, what I want you to focus on is simply that the difference between the base case and the planning case is currently zero. Difference in effective rates is zero. The difference in actual amounts paid in income tax and IRMAA are zero. And this is where you should be after you have completed up through step 6 of the Roth conversion flowchart. By completing the process through step 6, you have laid out the base case. That is what this couple in the example above that we just went through has done. All of the numbers that we have covered thus far in this video represent the base case. Starting right now, from this point forward, we are going to do the planning steps. That's what step 9 is. It's the planning for strategic Roth IRA conversions. In order to do that, we have to lock the base case. In other words, as soon as we start making changes above in the spreadsheet, which we are going to do just moments from now, we no longer want the base case to change. The base case needs to remain constant as it was set up through step 6. That way, when we take our planning steps, only the planning case will change, and we can then see the difference between the planning case and the base case, thus showing us whether our planning steps are working appropriately, or if they need to be modified, or whatever the case may be. So I have done that. I have locked the base case right here. That will cause the base case in this row and this row to remain constant, and we are now ready to perform our Roth conversions. Okay, coming back up here to the tax brackets, the first thing we're going to do is identify and tackle the most obvious areas where we can obtain tax savings. We're going to go for the low-hanging fruit first, and then we're going to move to perhaps the less obvious items. So the first obvious item is going to be this right over here. Because we allowed the inherited IRA to balloon due to not taking more than the RMD required in the first 9 years, we are bumping up right here into the 32 and 35% tax bracket. If you recall, this is 2033. If we scroll back up, this is the year where we saw the inherited IRA balloon right here, okay? So tackling this one right here in our current situation appears to be sort of a no-brainer move. Okay, now going back down here, we want to take this income out of this year, and the next question is, where are we going to put it? The most logical choice would be to try to put it in the earliest year available, and we have kind of 3 main buckets right here to choose from. At first glance, these kind of look about the same, particularly 2028 right here and 2026. However, there is an identifiable difference between those 2 years. Even though when we look at the amount of taxable ordinary income right here, $64,000 and $48,000, they look like they're about the same. And thus the amount of ordinary income tax being calculated looks like it's about the same. But where we see the difference right here is in total taxable income. We have $157,000 of taxable income here, but only $62,000 of taxable income here. And the big driver of that was our financial advisor, remember, who said, you know what, I'm thinking about harvesting $80,000 of long-term capital gain in 2026. Now, from a tax planning perspective, I'm not sure I like that idea. I don't know if I like this harvesting right here of the $50,000 and this harvesting right here of the $80,000. This, by the way, in this example is not complete. We said this is what the financial advisor is recommending for the current year, but these numbers are still fluid. Maybe they need to be changed. Maybe we can find a better tax answer working in conjunction with the financial advisor, of course, because there may be non-tax reasons to complete these transactions right here. On the other hand, the financial advisor may just be churning the portfolio because that's what financial advisors tend to do sometimes. And maybe these transactions don't actually have to occur in 2026, or maybe they don't have to occur in these precise amounts. That is a conversation for you to have with your financial advisor when you are working on your tax planning. But nonetheless, we have these in here as estimates right now. And what that is doing is, if we scroll down just a little bit more, it is bumping up our AGI above $150,000. Now, why is the number $150,000 of AGI relevant to a couple married filing joint in 2026? And the answer has to do with the enhanced senior deduction that was put in place for 4 years under OBBBA. For a couple married filing joint, the maximum deduction is going to be $12,000, but we can see right here in 2026, it's already starting to phase out, and it's phasing out because that AGI is above 150. The key point we want to recognize right now is that because we're already in the phase out range right here, every additional dollar that we put into 2026 in this fact pattern will cause us to lose additional senior deduction. Now, on the one hand, maybe that's okay. Getting money out of the higher brackets and into lower brackets at the detriment of the senior deduction may still be beneficial on a net-net basis. We're going to test that out in just a moment. But because of those estimates that the financial advisor has given us for 2026, for this particular example, I'm going to go down here and say, let's start on 2027 instead. And the first thing I want to do is get as much money out of this year as I can to get us out of these brackets and fill up these lower brackets over here. And for the first pass of doing that, I want to carry income into this year only up to the point where we don't exceed $150,000 on AGI. All right, so let's do a little side calculation right over here. I'm going to drop in $150,000 for the amount of AGI that I want to reach. Then I'm going to go right here, I'm going to hit equal sign, and I'm going to go find the amount of AGI that we currently have in this year, which is this cell, and I'm going to hit enter on my keyboard. Then I'm going to go back down here, and I'm going to subtract the AGI that we want to reach. We're going to subtract off the amount that we currently have to find out how much more income we can pick up without exceeding that desired level of AGI. That's $78,763 for 2027. Now, we also have the same opportunity in 2028. We are below that $150,000 of AGI right here. And so let's go down here and do one more side calc. I'm going to drop in the same $150,000 of desired AGI. I'm going to hit the equal sign on my keyboard. I'm going to go up here. I'm going to grab the AGI that we currently have and hit enter. And then I'm going to go down here and we're going to do the same subtraction to figure out how much more income we can absorb to reach that desired $150,000 AGI level. Okay, now before we make these two adjustments to the distributions from the inherited IRA, I'm going to go back down here one more time just to confirm that the difference between the base case and the planning case is 0 right here, because when we start to make these entries, we are going to see changes in the planning case, which will allow us to see how much tax savings we can obtain with our various strategies. Okay, so returning to this section, the first thing I'm going to do is make this adjustment right here, $78,763. That is the one we calculated for 2027. So I'm going to go to the inherited IRA. Okay, here we are on inherited IRA tab 1. Remember, the way that this works is the actual amount of RMD required on the inherited balance is calculated right here. And then the actual amount of distribution that you choose to take is simply entered right over here. In this case, you can see that the amount of distribution we are choosing to take at the moment is simply equal to the RMD, and that is how we end up with the balloon in year 10. And so that is what we are going to adjust right now. By the way, note right here that in 2027, spouse 1 is 69 years old. So we're going to go right here to the row where spouse 1 is 69 years old. I'm going to click on the amount of actual distribution taken. I'm going to go right up here to the formula bar, and I am going to add in the $78,763 of additional income, which we are now planning to pick up in this year and thus take out of the final year, the balloon, when I hit enter on my keyboard, you can see that this distribution has increased to 108,606, and the final year distribution, the balloon, has decreased accordingly. Okay, going back to the main tab of the personal tax planning template and looking at 2027, let's scroll up here and just make sure that we hit our desired $150,000 of AGI. Then let's scroll down here a little bit further. We can see that the amount of tax being calculated has increased right here for that year as expected, and the amount of tax being calculated over here has decreased. Recall that previously there was some tax being calculated here in the 35% bracket. That has been completely cleared out, and some of this has been cleared out as well. Not all of it at the moment, but we are making progress. So now let's go down to our base case versus planning case and see what the results are of that first item. Okay, and the results are a reduction to the amount of tax due over the lifetime of this example of $16,599. Also, just for additional clarity, let's just take a look here at the detail of the difference between the planning case and the base case. The first thing I want you to notice is the flip in AGI right here. You can see those two things net to zero right there. There's the sum of zero, because we have simply moved income out of this year and we have put it in this year. And the results of that are the amount of tax being calculated on this income in the lower brackets in this year is $9,119. The amount of tax being saved by getting that same amount of income out of the higher brackets in this year is $25,718. So if you sum those two up, that is going to be our $16,599 right there, which is this number. Okay, before continuing, I'm going to simply copy this number and I'm just going to memorialize it down here. I'm just going to paste a hard-coded value so that we can track all of the changes as we make them. So this was the first amount of tax savings that we determined. Take note right here that a negative number in this difference column is going to represent tax savings. You can see the total amount of tax over the planning case is now lower than the total amount of tax over the base case. So that was the result of our first pass item. Now let's go do the subsequent year where we calculated another adjustment. Back up here, we had determined that we can hit AGI of 150 in 2028 this time by increasing income by 37,748 and getting it out of the balloon. So let's go back over to Inherited IRA tab 1. I'm going to go to the row for the year subsequent to the year that we previously worked on. I'm going to go up here to the formula bar and I'm going to add in the 37,748 that we calculated on the other page. I'm going to hit enter on my keyboard. You can see this increased and this decreased accordingly. Let's go back over to the main tab. I'm going to go to the year 2028. I'm going to scroll up and just double check that our AGI has hit 150, and it did right there. So now coming back down here, we can see that tax has increased here and tax has also decreased there. We still have a little bit more to go right here, but let's go down to our summary of the base case versus the planning case and just see how much more tax savings we obtained. So now we're up to 24,148 in total tax savings across the lifetime of the planning. Once again, you can see that was caused by moving this income here, taking it out of this year. Those sum to zero right there. And we had an increase of tax in these lower brackets here, grand total 13,649. That is offset by this 37,797 of reduced tax over here. That's how we arrive at the 24,148 right there. And I'm going to go ahead and grab this number now. I'm going to memorialize it right there so that we can remember where we are after the second item. And now let's go back up here and see what else we can find. All right, so continuing to look at this item right here, we have not cleared out all the tax from the 32% bracket yet. And so the question is going to be, if I move more of this income out of this year and I put it in one of our first 3 years, let's say 2028, scrolling up right here, you can see that we have not started to phase out of the senior deduction yet, but we're right on the cusp. We're at $150,000 of AGI, so any more income I put in here will cause cause this deduction to start going down. And the question I have for you is, will it be worth it? Is it worth taking money out of being taxed in this bracket to get it taxed in one of these lower brackets right here, knowing we're going to start losing some senior deduction? Is it still worth doing? So in order to answer that, let's test it out, and then we will go back down to the bottom of the schedule and check the base case versus planning case and see if it was beneficial. So in order to accomplish that, let me just go right here above this row to this blank cell. I'm going to do a side calculation here. The side calculation is I want to clear this out completely, which means I can't have taxable ordinary income in excess of the top of the 24% bracket or the previous bracket. So how much income can I reduce? Well, let's go to this cell right here. I'm going to hit equals. I'm going to grab the amount of taxable ordinary income that we have already, and from that, I'm going to subtract off the top of the 24% bracket, which can be found right here in this cell. I'm going to hit enter, and it looks like we need to reduce income by $34,546 in order to clear out this bracket entirely. So now what I'm going to do is go back to the inherited IRA tab. I'm going to go to the second year that we were working on, and I am going to throw in right here in the formula bar another $34,546. Okay, and I'm going to hit enter. We can see the amount of distribution we're actually taking from the inherited IRA is in excess of the RMD. This item right here has gone down accordingly. Let's go back to the main tab and check out the results. Okay, we can see right here that we have successfully cleared out the 32% bracket in 2033. We can see right over here that we filled up the 12% bracket and we are getting some income taxed in the 22% bracket back here in 2028. Now scrolling up right to here, we can see that our AGI is now above the 150 marker, so we are starting to lose some of the enhanced senior deduction that is going down from the $12,000. But the real test is going to be at the bottom in the planning case. Did we save additional tax versus where we were earlier by that move? Let's go down here and see. We are now at $26,655 of tax savings across the life of the scenario. We were previously at $24,148. So in this particular fact pattern, it was worth losing some senior deduction in order to get the rest of that income out of the 32% bracket and into the lower brackets. So let's go ahead and memorialize that number for our next pass. And now let's go back up here and see what else we can find. All right, now going up here and looking at the next 2 years, 2029 and 2030, as of the moment, there is no such item as the enhanced senior deduction applicable to those 2 years. Now, is it possible that that provision could be extended? It's absolutely possible. It could be extended, it could be eliminated, it could be modified, it could be replaced. Anything is possible in the future. So remember what I have told you many times before. When you are doing tax planning, we must do our tax planning within the boundaries of existing law or whatever the law could reasonably be expected to become. Right now, the existing law is that there is no such item as the enhanced senior deduction beyond 2028. So what does it mean could reasonably be expected to become? What does that phrase mean? Well, generally speaking, from a tax planning perspective, it would mean that an actual proposal at a minimum has to exist somewhere in Congress. There has to be some reasonable expectation of appetite within the government to make such a change. Extending the enhanced senior deduction would require a change. In other words, it would require action on the part of Congress. If no action is taken, then there will be no such item as the enhanced senior deduction. So no enhanced senior deduction is the current law, quote unquote, because that's what would occur without any action. Right now, in the middle of 2026, there is no discussion in the government of extending any of the items related to OBBBA beyond 2028. That is not discussion we will probably hear about until maybe late 2027, more likely sometime in 2028. All of those provisions are set to expire right around the time of the next presidential election cycle. I think that was probably intentional so that those items can become campaign issues. But from a tax planning perspective, we cannot plan for something that currently does not exist and for which there is no proposal to have it exist. We cannot plan for the existence of that item. If we could, then we can just make up anything and plan for any possibility, but none of that is realistic. We can only plan at any given time for what the law currently is, or if it reasonably could be expected to change based on actual proposals or discussion or something actually happening in Congress. So as of today, we have to plan that there is no such item right here. With that in mind, the $150,000 AGI threshold no longer becomes relevant because there's nothing here to phase out. Therefore, we have ample opportunity to do some Roth conversions in this year, and let's make sure we understand why that is. Based on the analysis as currently set up, in all future years from 2031 and beyond in this fact pattern, if we go all the way out here, there is never a year, as you can see right here, going out all the way until spouse 2 reaches 90, which was one of the assumptions that the couple made in this planning example. There is never a year when we are taxed at lower than the 24% bracket. In fact, in some years we are taxed as high as the 32% marginal bracket. That is because of widow's penalty in this example, which we're testing right there. So going back over here, under that fact pattern, we have a no-brainer move of doing Roth conversions to fill up at a minimum the 22% bracket and probably even some 24% bracket because we want to get income out of the 32% bracket later. But let's start with the most obvious no-brainer, and that is filling up the 22% bracket in these 2 years. Okay, in order to accomplish that, we're going to do 2 side calculations right here. By the way, keep the personal tax planning template clean. We are done with these side calculations. I'm going to delete those. We are done with this side calculation. I'm going to delete that. Right now, we're going to do 2 side calculations here. And what is it that we are looking for? Well, we need to know how much income we can pick up in order to fill the 22% bracket. So what we're going to do is I'm going to go right here. I'm going to hit the equal sign. I'm going to go grab the top of the 22% bracket, which is right here. Then I'm going to hit the minus sign on my keyboard. Then I'm going to go right up here to total ordinary income. That's the amount we have right now. I'm going to hit enter on my keyboard. We have room to pick up $106,775. I'm just going to drag that same calculation out one more year, and we are going to have $109,730 in that year. These are the amounts of Roth conversion that we can do to fill up that 22% bracket. So starting with 2029, I have $106,775. Let's go to RCTS tab 1. Okay, here we are on RCTS tab 1. I'm going to go to the 2029 row. I'm going to go to the tentative Roth conversion. I am going to type in my 106,775. Make sure to type in your Roth conversions as negative numbers, as I have done right there. And now let's go back to the personal tax planning template main tab. You can see right here that our side calculation has been zeroed out because we have total ordinary income equal to the top of the 22% bracket. So that Roth conversion is complete. Let's go down to our analysis and see where we are. We are now at $35,270 of tax savings. You can see right here in the detail that what happens with the Roth conversion is that the amount of income that you converted appears here, but where it comes out of is all future years. And while the amount of additional tax calculated is here, where all the additional tax savings occurs is spread out through all future years. That is the nature of the Roth conversion, because when you accelerate the distribution out of your traditional IRA, you're simply reducing the IRA balance, and so you're basically reducing the amount of every future RMD. Mathematically, it's the same concept as we went through with the inherited IRA item, except with the inherited IRA item, all of the savings was concentrated in the single balloon year. With the traditional IRA that is yours, where you are the owner, there is no balloon year, and therefore the savings does not get concentrated in one year, it gets spread out over time. So anyway, with that Roth conversion complete, we are now at a grand total total of $30,719 of tax savings. Plus, we picked up some IRMAA savings as well by shifting that income around. So we're at a grand total here of $35,270. I'm going to go ahead and copy and memorialize that item right here just so we can track the progress of what we're doing. Now let's go back up here. We're going to do the second Roth conversion, which is this 109,730. That is going to be in 2030. So let's go back to the RCTS tab 1. Okay, here we are on RCTS tab 1. I'm going to go to the next year, 2030. I'm going to put in that 109,730 that we calculated. Now let's go back to the main tab. We can double check that the amount of taxable ordinary income right there equals our 22% bracket. So our side calculations have been satisfied. I'm going to go ahead and delete those. Then I'm going to scroll down here to the results and we can check out what the next round is. I think this was the same amount of IRMAA savings as last time, so we didn't pick up any additional IRMAA savings there, but we did pick up some additional tax savings. We are now at $39,188. I'm going to copy and memorialize that item right here. Okay, so those two Roth conversions are done. Let's go back up here and see what else we can find. All right, scrolling over to the part of the calculation where we're still getting bumped up right here into the 32% bracket for widow's penalty. Now, in addressing this issue right here, there are two things that we want to keep in mind. The first one is, remember how I said when you do a Roth conversion, the savings gets spread out over time, over the remaining time in the calculation. So if we want to address these years right here specifically, we will probably get a little more bang for our buck if we do our Roth conversions as close to this year as possible, as compared to doing them way back here when it won't be quite as impactful on these years right here specifically. In addition to that, when making our determination of how much more income to pick up in these years right here, we want to be mindful of IRMAA. So let's just start with the first relevant year here, working our way backwards. That's going to be 2042. And the first thing I want to check is what is the amount I can pick up and not impact IRMAA in the year when 2042 impacts IRMAA, which, as you know, is going to be 2 years later, 2044. So let's go to the IRMAA surcharge calculator right here. All right, and now that we're over here, we want to look for the relevant year in question in this row right here, relevant MAGI year from 2 years prior. In this case, we're looking for 2042 is the year in question. And then I want to go down here and see how much more income can I pick up in 2042 without sending us over the IRMAA cliff into the next bracket, and the answer here is 32,000. Let's just go ahead and round that to 30,000, just leave a little bit of cushion right there. In fact, I think I want to work on the next 2 years prior as well, so let's round that to 20,000, and then let's round that to 10,000. So basically, I'm going to do a conversion of 30, 20, and then 10 right here in 2042 back to 2040. Let's go back to the RCTS tab and enter those conversions. Okay, so starting right here in 2042, I'm going to do a $30,000 conversion. Then I'm going to go back a year. I'm going to do a $20,000 conversion. And then I'm going to go back to the previous year again and do a $10,000 conversion right there. Now I want to go back to the IRMAA calculator one more time, and I want to check out any earlier years here. In 2039, we don't seem to have a lot of room. 5,000. Let's just go ahead and round that to 4,000 just to leave a little cushion. I'm going to pop back over here to the RCTS tab. I'm going to do a $4,000 conversion right there. And then one more look on the IRMAA tab. In all of these years back here, we have a fair amount of room. I'm just going to do a blanket $10,000 conversion over these 5 years right here. So let's hop back to the RCTS tab. I'm going to drop in a $10,000 conversion there. And then I'm going to go ahead and drag that back for 1, 2, 3, 4 more years. So I'm going to do $10,000 conversions for 5 years. Then I'm going to do these conversions that we calculated so we didn't go over the IRMAA cliff. All right, and let's now go back to the analysis. Over here, I can already see that we managed to clear out the 32% bracket right here in the 5th year. We haven't cleared out the first 4 years yet, but we did reduce the amount of tax. Let's go down to the results and just see where we are at with the cumulative tax savings from our strategy. Right now, we're up to 41,526 by doing those additional conversions in those later years. I'm going to memorialize that number. And of course, you can always go back again now at this point and start tweaking and refining these items to get a little bit more precision. That is something I highly recommend that you do with your own numbers when you are figuring out the ideal amount of Roth IRA conversion to complete in these later years. I also think it's worth pointing out right here that people often ask, should I do a Roth IRA conversion once I'm already in RMDs? And the answer could very well be yes. Usually it's not going to be a larger conversion as we might do over here when we have a lot more room, but you may still be able to obtain thousands of dollars of savings with smaller Roth IRA conversions if you have the ability to move income out of a higher bracket still, just like we're moving income out of that 32% bracket and into the 24% bracket. No matter what your age or RMD status, if you can get income out of a higher bracket and into a lower bracket through a conversion, you will typically find it to be beneficial and to your advantage. Okay, now switching gears for a minute and scrolling back up here, I want to think about 2026 again, and I think I want to have a little talk with our financial advisor in this case, because we have a couple of items to consider here. Number one, this $50,000 right here of short-term capital gain harvesting, this right here is not doing us any favors from a tax perspective. If we could get this item deferred or pushed out into a future year, it looks to me like we have a triple whammy tax savings opportunity right here, and everybody loves a triple whammy. So this is the kind of thing where you want to talk to your financial advisor and make sure you understand the underlying investment rationale to be harvesting this item right now, because 9 times out of 10, your financial advisor is not thinking about your tax situation. And so it's certainly possible that the investment rationale for doing this may not be as strong as you would like, and maybe we can figure out how to defer this item. For example, let's just say that the situation was, instead of completing these sales now in 2026 and harvesting all this short-term gain, what would be the triple whammy tax savings opportunity if we could push this item out to, let's say, 2029? Well, whammy number one is going to be that this item itself will turn from short-term capital gain into long-term capital gain, so we have the potential to realize some tax savings there. But the second whammy is that by including this $50,000 this year, if we scroll down here to the enhanced senior deduction, we are already losing deduction due to the phaseout. And if we were to defer that $50,000 of short-term capital gain, this would go back up to $12,000. And then finally, the third whammy is that if this $50,000 wasn't here, our income in total would be low enough that almost all of this long-term capital gain and qualified dividend would actually get taxed in the 0% long-term capital gain rate instead of the 15% rate. To see that, let's hop over to the capital gain full calculation right here. You can see that if I go to the 2026 column and we scroll down to the full calculation, this row right here will show the amount of income being currently taxed at the 0% rate. In this case, we have $34,000 there. But if I was to go to where we enter the capital gain information, there's the $50,000. Let's say I was able to defer that till 2029 and turn it into long-term capital gain. Obviously, I have an underlying assumption here that the investment value is not going to change, so that's obviously not going to be exactly the amount of long-term capital gain that would ultimately be there in 2029? Just for analysis purposes, let's just put the $50,000 over here and take it out of the short term right there. Then if we go back to the capital gain full calculation and look at the amount being taxed in the 0% rate, we can see it's the $90,594 now. I believe that's actually the full amount. Let's go back here and double check that. Almost the full amount. The full amount is $93,449 on the long-term capital gain and qualified dividends. By deferring that $50,000 to the future, in other words, by putting it right here in long term, we got nearly all of this taxed at the 0% rate. And not only that, we increased our senior deduction, I believe. Yep, we got back the full amount of senior deduction that was previously being phased out. So if we can talk to our financial advisor and figure out if the underlying investment rationale would allow for us to try to defer some or all of that 50 out of short term and into long term a little bit later on, then let's go down and see how much tax savings we picked up from that strategy in our summary down here. And right here you can see we're now at $44,812. It looks like we lost a little bit on IRMAA by putting the $50,000 in 2029. However, we did make up for that with the triple whammy tax savings that we got from doing that. And of course, we could always go back and tweak that more and see maybe if we did $25,000 in one year and $25,000 in another as opposed to $50,000 in the full year. There's any number of combinations that we could figure out to see if we could not impact IRMAA while simultaneously getting our triple whammy. But for right now, let's just say, okay, net, we still came out ahead on all of that tax savings versus the amount we lost on IRMAA. And so now we're at $44,812 total on the cumulative strategy that we've been employing right here. I'm going to memorialize that. And then there's one more item that I want to talk about with our financial advisor while we have him or her on the horn. And that is scrolling over here to the interest and dividend entry tab. Let's see what we have going on right here. You know, I'm wondering, looking at this, these are the amounts of dividends that we are collecting from our various investments, but I'm not sure that I really like the breakout of that item between qualified dividends and non-qualified dividends. For example, what if we could rebalance our portfolio starting in 2027, because 2026 is already half over. Let's think about 2027 and beyond. What if we could find investments of equivalent risk where we could increase the amount of qualified dividend? Maybe not all the way. Let's just say that we could pick up an additional $5,000 of qualified dividend, thereby reducing the amount of non-qualified dividend that we're getting by the same amount. Note that we're still picking up the same amount of total dividend right here. We're simply changing the character from non-qualified to qualified. Now again, you want to talk to your financial advisor to determine if the underlying investment strategy would allow for something like this, identifying dividend-paying securities of equivalent risk where you could get more income of this character and less income of this character. And let's say we were able to do that starting in 2027 out to the end of the calculation here. Remember again, nothing has changed with the total amount of dividends that we're picking up. We're simply reshuffling the character, and if we can do that for equivalent risk, it would be a no-brainer item to do that from a tax perspective. Okay, so by doing that, let's go back now to the main tab. Again, looking right here, we can see that qualified dividends are up and non-qualified dividends are down by an equivalent amount. Let's just go down here and see what the tax savings effect of doing that was in our base case versus planning case scenario. So right here, we're at $56,000 of total tax savings by changing the character of the dividends that we are receiving from our investments starting next year and over time. And so the long and short of it is there are many tens of thousands of dollars or more in tax savings out there in everybody's situation. But you can see from today's analysis that there are so many different moving parts in tax planning that there is no way you are going to be able to find these opportunities in your head. You have to lay out your fact pattern, you have to establish your base case, and then you have to analyze the data to find those opportunities and accumulate all of those opportunities together to find the most optimized tax situation for your facts and circumstances. In this video example, we found $56,000 of tax savings in under an hour. I am confident that nobody watching this video has ever made $56,000 in an hour. Maybe some of you have, but I'm confident that most of you haven't. Sitting down with the personal tax planning template and laying out your numbers and figuring out where your personal specific tax savings opportunities lie may very well be the most lucrative hour that you have ever spent taking a real deep dive and hard look at your financial situation. All right, so with that, summer 2026 tax planning with the personal tax planning template program has officially begun. I am now back in the office for the summer season, so if you are already a member of the personal tax planning template program, keep an eye out for all new members-only content that will be posted to the training area throughout the summer season. And if you're not already a member, the personal tax planning template and comprehensive video training program is available for purchase at the link in the description below this video. Your purchase helps out the channel and provides you with a tax planning and analysis toolset that you can use for the rest of your life to help minimize your taxes and maximize the after-tax cash flow that remains in your family's pocketbook. So it's a win-win for everybody. Download the program, follow the Roth IRA conversion flowchart, binge watch the extensive training content, and make 2026 the year when you finally understand how to save your family meaningful amounts of money in taxes, just like the professionals. As I said, the personal tax planning template and video training program is available in the link in the description below this video, and I look forward to seeing you inside the class.